Assalamualaikum, this is our presentation video for our group assignment. We are from JBA2723C. I would like to introduce our group member first. My name is Putri Nuranzurin binti Jamaluddin and my group buddies are Aisyah Atira binti Arifin, Nur Izzati binti Muhammad Sofian, Nuruliana binti Jamil, and Siti Nur Syuhada binti Malaysia. Firstly, capital structure refers to the way a company finances its operations and growth through a combination of debt and equity. The mix of debt, which is borrowing funds, and equity, which is ownership funds, is crucial in determining the risk and the return profile of a business. While debt can provide companies with additional capital to expand or fund projects, it also comes with inherent risk and limitation that needs to be carefully managed. Next, the use of debt in a company's capital structures has its advantages, such as tax shield from interest deductions, lower costs and capital, and the ability to leverage business operation for higher returns. However, excessive reliance on debt can lead to financial distress and increase the risk of bankruptcy. There are several limits to the use of the debt, including the risk of over-leverage, the ability to meet debt obligations, the cost of borrowing, and market conditions. Understanding these limits are crucial for businesses in balancing their capital structure. A company must ensure that its debt levels are sustainable and that it can maintain the flexibility to adjust to economic downturns, changes in market conditions, and shifts in investor sentiment. The optimal capital structure, therefore, is one that minimizes the cost of capital while keeping the company's risk at manageable levels.
What is capital structure? Capital structure describes the mix of debt and equity in a firm's long-term capital, which is used to fund its ongoing operation and future growth. An easy way to understand a capital structure is how the company raises the fund to run its business. Furthermore, a capital restructuring refers to altering the level of a firm's leverage without affecting its assets. The firm can increase its leverage by taking on more debt and buying back its existing shares. Conversely, the firm can reduce its leverage by using new shares and paying down outstanding debt. A company's capital structure is reflected in balance sheet. Investors may analyze a company's capital structure on its balance sheet to assess whether it's a strong investment. There are two components of capital used by a company to fund its assets and support and run its business, which are equity and debt capital. Firstly, equity capital is divided into three, which are common stock, preferred stock, and retained earnings. Besides, debt capital includes two, which is long-term and short-term debt. In conclusion, capital structure is a combination of company equity and debt. A company raises money from that particular combination to finance company operation and growth. An ideal capital structure is the best mix of debt and equity financing that maximizes a company market value while minimizing capital costs. The best lower cost financing mix is called optimal capital structure. The purpose of optimal capital structure is estimated by calculating the mix of debt and equity that minimize a company's weighted average cost of capital, WACC, while maximize its market value. So, how to determine optimal capital structure? The optimal capital structure of a company is impacted by WACC, cost of debt, and cost of equity. To determine the optimal capital structure, the company needs to consider factors such as weighted average cost of capital. Companies need to determine the capital structure that maximizes the company market value by minimizing their cost of capital. The goal of the finance team is to find the best mix of borrowing and investing that will lower the WACC, making the company more valuable. The lower the WACC, the more the company is worth, which helps the shareholder. An optimal capital structure is the lowest is WACC. While deciding on the optimal capital structure, the company can understand the trade-off between debt and equity. A company can issue more debt and equity than they face by trade-off. When investors want to assess how risky a company is, they often look at its debt or equity ratio. This ratio shows how much debt the company has compared to equity. Investors also compare this ratio with other companies in the same industry, assuming that those companies have found the right balance between debt and equity. If a company has much more debt than its peers, investors might see it's riskier, so companies need to find the right balance between debt and equity. The optimal capital structure means having enough equity share to lower the risk of default, while still using debt to take advantage of its lower cost. The goal is to find the optimal capital structure where the company uses just the right amount of debt to stay competitive without taking on too much risk. In short, the company can optimize the debt and equity mix. Taken finding the optimal capital structure is about balancing debt and equity. The company should use just the right amount of debt to reduce its cost of capital, increase its value, and stay financially safe. By carefully looking at how much debt and equity cost, along with the risk involved, the company can figure out the best mix that boosts shareholder value while keeping the cost of financing as low as possible.
Now, this is a factor that affecting capital structure and capital structure decisions. First, we have size of the business. Size of the business affect its ability of raise finance in the firms. Compared to a big company, small size company face a difficulty in raising a long-term borrowing than the big firm. This is because creditors are hesitant to give them a loans because the scale of their business operation is not as good as bigger company. The second one, we have cost of capital. Cost of capital is an important factor in determining the company capital structure. The cost of raising funds depend on the expected rate of return for the supplier because these rates depend on the risk borne by investor. Not just that, ordinary shareholder usually face a maximum risk compared to a bigger shareholder as they don't get fixed rates of dividends. For the last one, we have tax benefit considerations. The effect of tax on company overall related to debt usage in capital structure. Rather than influencing the total debt in the company capital structure, taxes affect the relative composition of debt, and increasing in firm marginal tax rate, it will affect the debt in capital structure. Now, this is a definition of financial distress. Financial distress is a term commonly used in corporate finance where it promises the creditor of a company are broken or honored with difficulty. Financial distress generally happens due to high fixed costs, a large degree of liquid assets, or revenue that's sensitive to economic downturn. Furthermore, financial distress can arise from a poor budgeting, overspending, too high of debt load, lawsuit, or loss of employment for individuals. When a condition of financial distress occurs in the management of a company, it must be addressed immediately in order to for the condition not to worsen. For the last one, we have a distress cost. Distress cost is the cost that firm in financial distress face beyond the cost of doing business, such as higher cost of capital. Companies that are in cost distress tend to have a harder time meeting their financial obligation because they have a higher probability of default.
If you see this slide, I will explain about integration of tax effects and financial cost distress. For your information, there is trade-off between tax advantages of debt and the cost of financial distress when the company chooses a capital structure. Higher cost capital can affect company experience financial distress. It is because it incurs additional costs. Companies that involve in distress have higher default since it's more difficult to fulfill financial commitments. Debt financing is common for organizational structure, either short-term or long-term. According from Modigliani and Miller says that debt raises a company value when businesses' taxes are in effect. Nevertheless, financial analysts have maintained the cost of filing for bankruptcy will reduce company total worth. So, on this slide, we can see about tax effect and financial distress from Modigliani and Miller's theorem M&M, meaning there is a relationship between the value of the firm and the debt. As we can see, the VU is value of firm without no debt, while VL is value of firm under M&M without corporate tax and debt. So, the difference between VL and VU is present value of tax shield on debt. The difference between VL and V is the present value of financial distress cost. So, the present value of financial distress cost will reduce the value of the firm. For this slide, I would like to say about agency cost of equity. Agency cost of equity means agency costs associated with the conflicts of interest between a firm management and shareholder. The company's shareholder bear the risk, whereas the compensation of management is frequently linked to the company's performance, potentially resulting in managers taking on excessive risk. Since shareholders recognize this conflict, they will implement measures to reduce this cost, and at the end of the result is referred to as the net agency cost of equity. Therefore, the agency cost will encompass both the expense resulting from poor decision and the cost associated with overseeing management to stop them from making such choice.
The pecking order theory, or also known as the pecking order model, introduced by Stewart Myers and Nicholas Majluf in 1984. The theory proposes that managers follow a hierarchy when choosing sources of financing. It is connected to the capital structure of a company. Based on the theory, managers prioritize funding investment opportunities in the following order, initially using the company's retained earnings, then turning to debt, and finally issuing equity financing as a final option. The pecking order theory is based on the concept of asymmetry information, or called as information failure. It takes place when one party holds more or better information than the other, leading to uneven distribution of power in the transaction. Managers of a company typically have greater information into its performance, risk, prospects, and future outlook compared to external parties, including investors, which are shareholders, and also creditors, which are debt holders. Consequently, to address information asymmetry, external parties require a higher return to compensate for the risk they are undertaking. In short, external funding sources seek a higher return to compensate for the greater risk involved because of the information asymmetry. According to the framework of the pecking order theory, financing through retained earnings, which is internal financing, is sourced directly from the company and serves to reduce information asymmetry. Compared to external financing options like debt or equity, which require the company to pay fees, internal financing is the most affordable and convenient source of funding for the company. When the company uses external financing, including debt or equity, to fund an investment opportunity, creditors and investors require a higher return due to having less information about the company compared to its manager. When it comes to external financing, managers tend to choose debt over equity because the cost of debt is generally less costly than equity. Issuing debt typically signals that the stock is undervalued and indicates that the board's confidence in the profitability of the investment. In contrast, issuing equity often sends negative signals that the stock is overvalued and the management is attempting to raise capital by diluting the ownership of existing shareholders. In the context of the pecking order theory, it is important to consider the hierarchy of claims to assets. Debt holders seek a lower return than stockholders since they are entitled to hold the higher claim on assets if the company goes bankrupt. Thus, when determining financing options, retained earnings are the most affordable, followed by debt, with equity being the most costly. Signaling involves the use of insider information to make a trading decision or take a position in the market. It happens when an insider shares important information about a company, causing individuals who do not normally have access to such information to engage in buying or selling its stock. The insider's actions are interpreted as a market signal to external parties in the market. Market signaling can be detected by monitoring the shareholding and trading activities of a company's insiders. Insiders are generally senior executive or significant shareholders of the company. They may have the authority to make decisions and access to confidential internal information about the company. Insider information refers to private details that provide traders a competitive advantage in trading the company's stock. Trading involves recognizing and analyzing market signals generated by a range of technical indicators. For instance, candlestick patterns are used to analyze a security's price in order to forecast its future price movements. The movement of bullish and bearish trends offer traders with distinct signals. The candlestick patterns generates market signals that help to determine whether to take a long or short position in the market. One of the common approaches for investors to use in stock trading is to rely on insider trading activity as a market signal due to the fact that insiders typically have a more comprehensive understanding of the company, providing valuable insights into the stock's valuation. If an insider sells a significant amount of a company's stock, it may serve as a negative indicator which is bearish for the stock's future performance. External investors might interpret these signals as a cue to sell their own shares. On the other hand, when a senior executive makes a large volume of stocks purchases, it may due to insider information available only to a limited group within the company. This action typically signals expectation of positive future performance or enhanced financial recovery, encouraging investors to follow the executive's move and purchase the stock. According to the dividend signal theory, an increase in a company's dividend payout is seen by financial analysts and investors as a signal of positive future financial performance. Although many analysts remain doubtful about the theory, there is a degree of evidence supporting the theory's credibility. In most cases, higher dividend payouts are viewed as a sign of strong financial health and higher future stock prices. Conversely, a reduction in dividends may indicate potential financial struggles ahead. The dividend signaling theory claims that companies paying highest dividends tend to be more profitable. Nevertheless, some research suggests that dividend payouts do not necessarily reflect earnings.